Hi, students. Now we're going to talk about uh, core concept in entrepreneurial finance. I'm Yosef Bonaparte, professor in finance. See you then. Valuation models overview. So we have a different models like DCF, discounted cash flow, comparables, market multipliers like EV divided EBITDA or PE ratio, VC methods like exit value plus target ROI, common early stage ROI, a scorecard, which is a qualitative early stage approaches. So we have a different models. Which model to use for different stage? So for example, in the seed stage, valuation models by stage, in the seed, we can see that qualitative and VC methods are most common model to use. VC methods and qualitative are the this and this are the most one, and we can explain what is that models. Series A, you start doing comparables. In Series B and on, you start doing DCF, like a ChatGPT or OpenAI. Now they are in this stage, which is DCF. I will have example here in the class with the ChatGPT. Pricing ChatGPT before the IPO. Dilution. What is dilution? Issuing new shares reduces founders' ownership. We have a figure showing when the investors' share increase, ownership share increase in the company decrease. Investors increase, owners decrease. The total company value may grow, but each slice can be shrink. So why you give up as an owner? Why you give up shares in the equity? Because suppose your business worth uh, $10 million. So you give 10% of the shares, then you go your business to somebody, to investor. So your share will be 9 million, and the new investors 1 million. No, not that way, because you start with 10, you give up 10% of your equity, but the value of the company increased to 15 or 16. So you have a 90% of $16 million. So delusion example, before Series A, you have 100%. After Series A, you start losing some equity, and B, you start losing. So you can see the ownership decreases. Valuation cap, pre and versus post. Pre money cap applied before new money, typically better for funders. Post money cap includes the new money, typically better for investors. Align expectation early, which is the SAFE convertible notes term. So here's example pre versus post money cap illustration. Post money cap, investors' ownership here become to be higher, and founder ownership is this. But pre money cap, the investors have a less ownership, but the owner has a big ownership. So the pre, you have a lot of ownership as an owner, a lot of percent of ownership as a founder, investors little, but when they gain investors more weight, more ownership, the founder losing from say 75 to 50, 60, and those people increase by 50. Discount rate basics reflects risk, time value of money. So when the Federal Reserve increases the interest rate, that increases the discount rate for all companies, venture capital and venture everybody. High risk, higher discount rate, lower present value. So the company price is something divided by discount rate. Something is the cash flow. When the discount rate increase, everything going down. So when the discount rate increase for whatever reason, so the price of the company equal cash flow divided by discount rate, we call it R. If R increases, then P decreases, because when the discount factor increase, CF divided by something high becomes to be low. Discount rates across stages, illustrate discount rate by stage. So the discount rate, which is the blue here, we see the more you go in advance, the risk and uncertainty about the company decreases, which is good. Because when you have a more, when you go to from C to Series A to Series B, your R, discount factor, decreases. That means the overall company worth more. Core concept recap, valuation model differ by stage, dilution, reduced founder percentage, ownership, pre versus post money cap, shift dilution between funders and investors, discount rate decline with maturity, and your homework. Your homework, please complete the 3 questions. Watch a video. Ensure that you did watch it. Give a like to the video. YouTube also, that would be one way to convince me. Write the 3 takes away from this and prepare one question would you like to discuss that will help us to see that you really understand the material. Thank you so much for core concept entrepreneurial finance. Hope you have a great day.